Good morning, ladies and gentlemen, and welcome to our webinar of the VSV-ASG Investment Pulse survey. My name is Abdullah Mohamed, and it is my pleasure to be your host today. With me are our two experts, Professor Manfred Stüttgen from the University of Applied Sciences, Lucerne. Good morning, Manfred.
Good morning, Abdullah.
And Vivian Jain, CEO of the Swiss Association of Independent Wealth Managers. Good morning, Vivian.
Good morning.
Hi. In this year, we have conducted the study for the 5th edition now, the Investment Pulse study, which is designed for and from Swiss independent wealth managers. And at this occasion, I would like to thank all the participants of that survey that made it happen, and also a big thank you to the association supporting us and also the University of Applied Sciences Lucerne that has done the research. Before we dive into the results, I would like to remind you of a few things. First and foremost, you can download the study results and the booklet at your webinars interface. There is also a Q&A button where you can submit your questions. We will receive them live here into the studio in Zurich and will discuss them at the end of the presentation. And thirdly, should you experience any technical issues, then please refresh your browsers, which should solve the majority of the problems. Now, without further ado, let's dive into the study results. Vivian, would you like to give us an overview of the profile of the participants, please?
Yes, sure. So for the first time, we asked the participants for their role and function. And it is to be said that there are some double counts in here because an average size of a wealth manager is approximately 5 FTEs, meaning that there are several people who have more than one function. So it's hard to distinguish in some cases between being a relationship manager and a portfolio manager. Then further, also for the first time, we asked the participants for their age. And with a median age of 55, this represents exactly what we can also see on the market. So all over the survey is representative with a participation rate of 100 wealth managers sharing their insights and a slight tendency to medium-sized wealth managers.
Thank you, Vivian. Glad to hear that the age also matches the market. Manfred, if we look at the setup and the methodology of the study, could you please take us through the results? How many wealth managers are larger ones, how many smaller ones, and where do they clients sit?
Yeah, absolutely. Thank you, Abdullah. If we look at the sample, we see that approximately 40% of the independent wealth managers are what we call small, and we make the cutoff point at 200 million assets under management. And you can see this on the chart, the left pie chart or sort of pie chart, when you add up the 8%, 14%, and 17%, that is the smaller ones. The other ones, approximately 60%, are the larger ones, so larger than 200 million, which means all different sizes are covered. However, we have a slight tilt towards the larger ones if we compare it to the overall industry of approximately 1,400 independent wealth managers. If you look at the right-hand side of the chart, the map, you see that most of them have end clients being domiciled in Switzerland or in Europe. 45% in Switzerland, 40% in Europe, and the rest, the remaining, like 15% have end client domiciles in like South America, Asia, Middle East, Africa, or the US. What you don't see on this chart is the client structure. We have almost all of the 100 respondents of our survey have end clients who are private clients. 93 out of 100 have private clients as end clients. 64 have institutional clients, and basically 58% of these 100 respondents have both private and institutional clients. If you look at the lower right-hand part of this slide, you can also see the reference currency in which client portfolios are managed. and that corresponds a bit with the end client domiciles. We have a 41% Swiss franc, 35% in euro, and the remainder in the US dollar, British pound, or other currencies.
Thank you, Manfred. One question that we've been asking the participants was, how do you generate alpha in your portfolios, right? This question was asked the previous year and also this year. So we're really curious to see the results.
Yeah, it's the holy grail of asset management or wealth management. And I walk you through this chart. We asked the question, which strategies do you use to generate alpha in your portfolios? And we offered 10 choices. You see the choices listed on the left-hand side, ranging from strategic asset allocation to market timing. And then we asked the wealth managers to rank the top 3. And if you look at the percentages on this chart here, the 77% who rated strategic asset allocation as the key lever, this adds up rank 2 and 1 and 3, or rank 1, 2, 3, which is absolutely the most preferred lever. Followed by single stock or bond selection. So most of the wealth managers say we pick stocks and bonds, and we do this actively. So that's the second biggest lever. And the third one is tilting portfolios towards specific regions or sectors. Some people say this is like the strategic asset allocation on the second level, so to say. So these are the 3 key levers. What you also see on the chart is thematic investments and rebalancing. They are not like the most preferred levers, but they are still there. And keep that in mind when we are talking about, or when we will be talking about sustainable investing. Their thematic investments pop up again as a number 1 strategy. And rebalancing is a different topic. Wealth managers don't say it's the number 1 lever to create alpha, create outperformance. However, that doesn't mean that they don't do it. Yeah, we see on a later slide that they do rebalance, but that is sort of their usual business, but they wouldn't consider it the key lever. Interesting enough, they say market timing is on the bottom. It's really number 10 of 10. They say that's not what we consider the most preferred way to create an outperformance for our clients.
Very interesting results and some consistency here, because in last year's edition we also saw that strategic asset allocation was ranked number 1 in the results. So to say, time in the market beats timing the market, right? In this year's study, we've also asked the question about the strategic asset allocation, right? We've even refined the question asking about the strategic asset allocation and the deviation from it. So if we look at the equity side of the portfolios, how does that strategic asset allocation look like, Manfred?
Yeah, I mean, the first thing to understand this chart here is that we say in a balanced mandate, and we define a balanced mandate as a 40 to 60% equity allocation. So in a balanced mandate, how do you define your strategic asset allocation for equities in a neutral state across the following regions? What we see here is the top bar says the average, and the color coding tells us about the regions. And the thing that springs to our eyes here is that the wealth managers who participated in this survey have a significant overweight in Switzerland, somewhat in Europe as well, and a slight underweight, if you compare it to capital-weighted benchmark, in the US. And we interpret this in a way that this corresponds to the end client's domicile, where we see that most of the end clients are sitting in Switzerland and Europe. That might be an explanation why they have this strong home bias here, the wealth managers. What you can also see on this chart here is a split. We looked into, can we figure out, are there any differences between smaller wealth managers, in brackets, who cover 200 million or less of assets, and larger wealth managers, 200 million or more. And the one difference that springs to our eye here is the yellow shaded element in the bar, where you see that the smaller wealth managers have a slightly lesser investment in the US equities, which is 25% here. The larger ones have 32% in US equities, which is a difference of 7 percentage points. So the smaller ones have a slightly stronger home bias here than the larger ones. Emerging markets in Asia Pacific, they are approximately the same, around 9% on average, or 8 to 10%, with the smaller and the larger ones in the emerging market equities. That is the equity side. Now we look into the bond side. Here again, with bonds, we see that, we wait for the click.
Yes.
But you know what, no worries. The bond side, I just explained the idea. We see that the wealth managers have approximately 25% allocated in government bonds, approximately 50% allocated in corporate bonds, and another 25% allocated in emerging market high yield and other bonds. And that's a very clear and interesting split. You see it when you add up the 6%, the 10%, and the 9%, that is 25%. These are the government bonds in Switzerland, in Europe, and in the US. Then when you look at the yellow parts and the dark red part of the first bar, the average SAA, there you can see that they have a bit more corporate bonds, which means they are probably looking for more yield. On the government bond side, you'd hardly get any yield, particularly not in Switzerland. So 50% in corporate bonds and the remainder in the emerging market and high yield bonds. Here again, we see differences with smaller wealth managers and larger ones. And it springs to the eye that the yellow part of the bar, the 23% here, which is European corporate bonds, they are overweighted compared to the larger ones. The smaller ones have more European corporate bonds invested than the larger ones. The larger ones are a little bit more diversified.
Thanks, Manfred. So really interesting results to see, right? On the equity side, strong home bias towards Switzerland, but also larger wealth managers that tend to invest a bit more in US equities. Mm-hmm. And on the bond side, a trend towards corporate bonds across small and big wealth managers. Mm-hmm. That was the strategic asset allocation. What are the results if we look at the deviation from the strategic asset allocation, so to say the tactical ones?
Yeah, the tactical asset allocation sort of mimics what we see on the strategic asset allocation. Let me walk you through this chart. It needs a bit of explanation. On the upper part of the chart, you see the equity tactical allocation. On the lower part, the tactical asset allocation on bonds. And the picture is pretty straight. Swiss and European equities are slightly overweighted. So the dots, the blue and the yellow dots, are right from the vertical, which means slight overweight. The yellow dot is 2026, the blue dot is 2025. And you see that this tactical asset allocation has rarely shifted year on year. However, on the equity side, you see that US equities are tactically underweighted, and there is a shift from last year, blue dot, to the left, which means last year they were slightly overweighted. This year they are slightly underweighted, or a little bit more than slightly underweighted. That is relevant on the US equity investment side. A picture that is sort of mirrors this development is the emerging market equity. Last year you had an underweight, tactical underweight. This year a tactical overweight. And again, there is a bigger shift in there. Asia Pacific equities, sort of the same, slightly underweighted, slight shift there. On the bond side, the picture is also pretty straightforward. Almost all bonds are underweighted, with slight exceptions like European corporate bonds or emerging market bonds. Yeah, but everything is like underweighted here, with most of the bonds being shifted even more to the left hand, like European government bonds, US government bonds, US corporate bonds. So all in all, underweight on the bond side with some exceptions, bit of an overweight on the equity side, and particularly with Swiss and European equities.
Thanks, Manfred. Vivian, if we look at the deviations, right, we see that Swiss equities are even overweighted more on the tactical side, and underweight in US equities, and also general underweight in fixed income. If you look at the results, is there anything interesting that you can observe or anything that surprises you?
I mean, while European markets performed better, US market went down due to the devaluation of the US dollar. What though is very surprising if we look at emerging markets, as you just mentioned before, the shift and the deviation, which is quite obvious to see. So I doubt that this is a surrogate for less US exposure, but I can explain it the way that as we have a very strong home bias towards Swiss and European equities and bonds, every further shift towards these asset classes is actually a bit a minor shift, so you don't really see it because you already have a strong home bias. Where else in emerging markets, which is quite a small asset class all over, any further shift towards more emerging market exposure will definitely stand out. So all in all, it is to be said that emerging markets exposure in the portfolios of wealth manager is still a small one.
But overall, more diversification across the regions.
And if I just may comment again on this chart, I mean, we did the survey the last week of February and the whole of March, which was the time where the markets were slightly turbulent. Just to give a little bit of context on this one, if there are any tactical deviations, they also should be read in this context of the month of March.
Very good point, Manfred. Thanks for bringing it up. If we look at portfolio rebalancing, right, that was a question that we've asked our participants in the previous year, but also in this year's edition. How and how often do they rebalance their portfolios, Manfred?
Yeah, I mean, the question is, how do they rebalance it? And we offered 3 different choices here. We said, well, do you do it opportunistically, tactically? Do you do it based on a threshold? Or do you do it on a time-based rule, periodically? And basically, 68% answered they do it opportunistically as their single strategy or in combination with one of the other strategies. The 68% being the 62 plus the 6%, that is the preferred rule of rebalancing. Threshold-based is 35%, and periodically is like 32% on average, which tells us that they very much prefer to opportunistically rebalance their portfolios, but most of them do it. However, the next question, because these were 2 questions, the next question explains the color coding of this chart. We asked, do you do it manually or do you do it in an automated way, like through a portfolio management system? And here again, the majority does it manually, like 62% do the opportunistic rebalancing in a manual way, 26% the threshold-based, and the 24% the periodic adaptations, they do it manually. The minority, 6, 9, and 8%, they have an automation process in place.
Vivian, if you look at the results here, right, we can see clearly that the opportunistic approach stands out, and as Manfred just alluded to, right, it's done predominantly on a manual basis. What could be the reason behind it?
This could be explained by the fact that the majority of wealth managers in Switzerland does not use a portfolio management system. So there is less standardization in this process, and my explanation that it is mostly done on a manual basis.
Yeah. Makes sense. Thanks, Vivian. If we look at the next question in our study, it's related to direct investments or the usage of third-party products. That could be funds or ETFs. Manfred, could you take us through the results, please?
Yeah, sure. What you see here is on the upper side, equities again, on the lower side, it's bonds. And the vertical bar is the kind of On the left-hand side of the vertical bar, you see the direct investments. On the right-hand side of the bar, you see the fund and ETF investments. And the big picture is pretty simple. Swiss equities have been and still are directly invested. So the yellow dot is sitting on the blue dot, rarely any changes compared to last year. On the government side, you see that most of the bonds are directly investment, have been directly invested last year, are being directly invested this year. Where wealth managers use funds and ETFs is on European equities, on US equities, and in a very pronounced way on emerging market and Asia-Pacific equities, including Japan. Yeah, and on the emerging markets and Asia-Pacific, the dot walks to the right, which means they are even more often being invested through wrappers, through products like funds and ETFs. On the bond side, it is the emerging markets again, as well as the high yield bonds that spring to your eye. They have been, and even more so, been invested through funds and ETFs. And you have to keep this chart in mind when we go on with our presentation, because we now will drill down on the funds and the ETF investments. So these are what we call the filter questions. The next charts are drilling down into those wealth managers who use funds and ETFs, and we ask the question, is it like actively or passively, or is it through ETFs or through index funds?
Right, Manfred. So let's start with the drill down, so to say. Let's start with the fund selection criteria, right? So when Swiss wealth managers are using third-party products, what are the selection criteria to filter out those products?
Yeah, we offered the wealth managers a choice of 10 different criteria, starting with historical track record. I mean, they were not sorted this way, but we had 10 different criteria. And here again, we asked them to rank them by rank 1, rank 2, and rank 3, which is the blue-greenish colors. We added them up. So 45% of the wealth managers said our key criterion to select funds is the historical track record. Yeah, the past performance of a fund. Fees and taxes play a very important role. 43% say fees and taxes are relevant. And then comes the first sort of qualitative criteria, the experience, the expertise of the investment manager and their team. So 36% say that is important, on par with liquidity, and then followed by the investment philosophy and the process. So these are sort of 3 hard criteria that are related to cost and performance, and 2 more qualitative or softer criteria, the expertise and the investment philosophy. Well, there are a couple of other things that matter less when they select funds, like benchmark comparisons, specific risk measures, fund provider strength and resources.
But if we pick out the top 3, right, it goes into historical track record, fees, and also the expertise of the investment manager.
Absolutely. And we saw that again last year. The order was slightly different. Last year we had like historical track record, fees and taxes, and liquidity. So minor changes here, but pretty much in line with our results from last year as well.
If we drill down on the product side, right, there are, as you said, active and passive products where Swiss wealth managers can choose from. If you look at the asset classes, what are the preferred ways to invest in each asset class? Is it more active or passive, Manfred?
Yeah, I mean, the answer is pretty simple. The big picture here is wealth managers in general prefer passive products when they use funds. So this chart is only answered by those wealth managers who are using funds. Yeah, the direct investing only wealth managers are not included in this chart. So if wealth managers invest in funds, they significantly prefer passive ones. And you can see this particularly in the emerging market and the Asia-Pacific equities, a bit in the US, well, not on Swiss and European equities, but even clearer on the bond side. Yeah, passive investments are key when wealth managers invest in government bonds, in brackets, which they rarely do. Yeah, you have small n's like Swiss government bond investments, 27 have answered this question. Yeah, but out of these 27, most of them use passive, and even more so. Yellow is usually right from blue dot here, which means there is a shift even more into passive investments. Swiss corporate, a bit more passive. European corporate, a little bit more active. US corporate, a little bit more active. Emerging market and high yield, a bit more passive. Minor changes year on year.
Thanks, Manfred. So to say, a clear trend towards passive investing. Now, Vivian, if we look at the slides, right, there are some dots that are basically a bit tilted towards the active side, in particular Swiss and European equities, but also Swiss corporate bonds and European corporates. Why is that?
And some wealth managers, especially fund managers, they're using their own products and they're actively managed. So this could be an explanation for this point. So for all others, it's clearly within the Swiss and European exposure investments, it's clearly single stocks which remain the main instrument for wealth managers. And as Manfred, you already mentioned, all over, if you use products and funds, there is a clear tendency towards using passive investments.
Very interesting to see. Thank you, Vivian, for the explanation. Now, if we stay on the passive side, right, there are ETFs and index funds to be used. Manfred, what is the preference across fixed income and equities if we look at the usage of ETFs or index funds?
Yeah, as you said, here again we drill deeper. So now we drill into those wealth managers who use passive products. This is sort of the context. When wealth managers use passive products, then on the equity side, they definitely prefer ETFs, which indicates the 56% in the upper bar, which both bars are equities, compared year on year. The upper bar tells us 56% prefer ETF investments to implement their passive strategies. The 40%, the blue element in the upper bar, says those wealth managers use ETFs as well as index funds. So they combine the two. And the 4% tells us that those wealth managers use index funds only to implement their passive products. Year on year, there is a slight decrease in the ETF-only users, so to say, and a slight increase in the combined ETF index fund users. Well, slight changes here, but a pretty clear picture. On the bond side, the combination of products is a little bit more pronounced. So the blue part of the third bar from the top has 47% in there, which means these wealth managers use ETFs and index funds as their preferred vehicle to implement their passive strategies. Only 40%, only in inverted commas, still a huge chunk, use ETFs only. 30%, the amber part of the bar, they use index funds only to implement their bond exposures. Slight changes compared to last year. Same pattern though, like on the equities side, more and more wealth managers use both ETFs and index funds and less lean to one only, one product only.
Thank you, Manfred. Before we continue with the other questions, I would like to remind the audience that you can download the booklet and look at the results whilst we're speaking. And also, should you have any questions, please do not hesitate to submit them and we'll receive them right here and discuss them in a bit. Another question that we've been asking the audience was related to sustainability, right? In all those years. So how does that picture look like, Manfred?
Yeah, I read this chart from the right-hand side where wealth managers answered the question, do you include sustainability in brackets, environmental, social and governance criteria in your investment process? And if you look at 2026, the right-hand bar, and you add up the green and the blue, then you could say 52% of the wealth managers, they do include ESG criteria in the investment process. However, the majority of those 52%, which is the 45%, they do it on client request, in brackets only, while the 7%, the minor part, does it by default. Yeah, and that part is slightly decreasing year on year, while the yellow part, the 48%, indicate those wealth managers who do not currently include ESG criteria, and there's a slight trend in moderation, so a little bit less wealth managers use ESG on a regular basis.
Interesting to see. Now, Vivian, if you look at the results, right, almost half say we do implement it predominantly upon the client's request, right, and the other half says we don't. What do you think could be the rationale behind the developments that we see here in the ESG landscape?
I mean, first of all, the wealth manager, he always works on an individual basis with his clients. So usually he does not use standardized or scalable investment strategies, such in a bank, for example. So every investment decision is taken individually. So this can be an explanation. Now, on the other hand, there is a big topic of criteria and data. So to implement a sustainable strategy, you need to define criteria. And this requires specialized know-how. It's very complex. And basically, there is a lack of uniformity and no clear process or definition in how to do that. And secondly, regarding the data, if you look at different strategies or, for example, impact investing or climate investing, you cannot do it without data. So you definitely would use data. Now, how is the access to this data? Is it freely accessible? No, it's not. So this is kind of a problem or challenge for a wealth manager because there is no uniformity in the data, it's not a clear access, and it costs.
Right, it takes extra steps to implement it.
Yes. And just to add, I think the wealth managers who filled out this part of the survey, I assume that they already use a certain degree of standardization because implementation of sustainable strategies in individual portfolio is practically impossible.
Makes sense. Now, if we look at the strategies, right, that they're using, Manfred, there are various ways to use it. Some are more data intense than others. What's the preference of Swiss wealth managers in that landscape?
Yeah, here again, we offered a list to pick and choose, and there are multiple choices available. So on average, we see that the wealth managers who use ESG strategies, they usually combine two of them. Yeah, and the most preferred ones this year are sustainable thematic investments and ESG integration. And if you remember the beginning of our presentation where we asked for the alpha drivers, thematic came, I think, in the list as number 4.
Right.
So there might be a connection here that they prefer thematic investments also as being an element of an alpha driver. Yeah, so that explains the choice here, or maybe can explain the choice here. ESG integration, again, is much more leaning towards financial risk considerations than maybe the best-in-class or the exclusion-based strategy, which could be motivated by risk-return considerations, but they could also be motivated by certain client values, yeah, which is a different ball game than here. Yeah, so best-in-class, exclusion-based, they still play a role. 30% use them, 25% use them, but less often than the sustainable thematic investments. Interesting enough, last year when we conducted the survey, best-in-class was leading the ranks here. What wealth managers, and Vivian, you mentioned that already, what they really do not very often do is pick and choose impact investing strategies, climate strategies, or engagement and voting strategies. All of them are pretty knowledge intense. You really have to have the data that you mentioned, Vivian, to implement them. They're a little bit more complex even than the other ones. That might explain why they are rarely used. The other thing, I mean, we saw differences. I won't go into the detail here, but you can see that then in the booklet that we share. We saw some minor differences between large and small wealth managers. Larger ones leaning a bit more towards ESG investing, smaller ones a little bit less. But we also saw that and we will come to that on the next chart then, differences in expertise. Some of the wealth managers claim they have a higher level of expertise there. Others don't claim that. They say, we don't have that expertise. And that correlates as well with the use of ESG strategies in general, and also with some of these particular strategies that we look at here.
Now, speaking about the expertise, right, we didn't only relate to the ESG topic, but overall we've been asking our audience where they see their expertise and how they would rank it. What are the top expertise areas, so to say, Manfred?
Yeah, the key elements of expertise, not a surprise: equity investments, multi-asset strategies, fixed income investments. Here again, we asked them on a scale of 5, do you consider your expertise as being very high, or is there no expertise? We added up the 2 first mentions, like very high or high, and 92% say, well, the equity investments is where we really have competencies and skills. Followed very closely by multi-asset strategies and fixed income investments. A little bit less so on certain investment styles, like, let's say, value or growth, or you name it, all those good styles that you can pick and choose. Where the wealth managers claim less of an expertise is alternative investments, private markets, like private equity or private debt, and then what we talked about already, the sustainable investments and the ESG, which ranks at the bottom here of the expertise. And maybe that is also one of the reasons why it is a less used strategy by the investment managers.
Vivian, if you look at the expertise of independent wealth managers, does that echo what you see in the market or from your members?
Definitely, yes. Especially if we look at the first 3, like equity investments, multi-asset strategies, and fixed income investments. That's clearly the core competence of a wealth manager. So if we go further down, the less experience or expertise is there, because it gets more specialized. So this part from the wealth manager side is usually being covered by a broad range of products. And we can also see, to make the link to what we were talking before, we can actually see that they will use passive investments for these areas.
Right. Thanks for your insights. I think that brings us to the conclusion of the study. Manfred, what are the key 3 takeaways from this year's results?
Yeah, I mean, what we see is we have a tactical overweight in equities, a strong home bias towards Swiss and European shares, and rebalancing approaches are used rather opportunistically rather than rules-based. That is kind of key takeaway number 1. When wealth managers implement their portfolios and manage them, they have a preference for funds and ETFs on the equity side, in brackets, except for the Swiss equities, which they usually directly invest. They have a steady preference for direct investments in most bond segments. So fixed income is usually directly invested with some exceptions. And we see that there is a shift more towards the fund implementation or ETF implementation side of things across most equity and bond categories year on year. Then last but not least, as we just discussed, wealth managers claim a strong expertise, and probably rightly so, on the equities, fixed income and multi-asset strategy side. That is where they see their skills and their competitive advantages, while they see less of their core strength in alternatives, private markets, and in ESG, and ESG investments have come down a bit.
Thank you, Manfred. That brings us to the Q&A session. We're almost up on time, but I think there is room for one question that has been submitted. So the question is, the study was conducted during volatile markets, right? Did this have an impact on the strategic asset allocation, or is that basically not impacting what results we got? Manfred, would you like to take that question maybe?
Yeah, sure. Well, if you looked at the strategic asset allocation, I mean, the respondents are all professionals. They know that strategic means like long-term, stable stick to the strategy. I doubt that this has been influenced by the March turbulence. The tactical asset allocation may be, but another argument why I think the strategic asset allocation that we described here is pretty stable and sticky is that the wealth managers say market timing does not play such an important role in creating alpha, which is another argument or another proof point to tell that the strategic asset allocation that we describe here is probably pretty stable.
So we're excited to see the next year's results to make that comparison, right? With that said, I would like to thank once again all the participants that made this study happen, the association, the University of Applied Sciences in Lucerne, and also you, the audience, ladies and gentlemen. Thank you for joining this webinar today. And we're looking forward to the next year's result already and the next year's presentation. Have a wonderful day. Goodbye.